Welcome to our deep dive on maximizing an inheritance using an aggressive Roth 401k strategy. In this video, we'll show how young investors can use a low-income year and inherited taxable funds to supercharge tax-free growth for decades. First, we'll set the stage, then move into the step-by-step plan, liquidity pitfalls, diagrams, and examples, followed by quick quizzes and a concise wrap-up. Let's begin. Here's the roadmap. We'll start with the context and why this strategy works. Next, we'll cover a practical step-by-step plan. Then, we'll address common liquidity pitfalls. After that, we'll visualize the strategy using diagrams. We'll reinforce learning with short quizzes, summarize key takeaways, and end with an important disclaimer. You're young and just received an inheritance. Your income this year is relatively low at around $55,000. This is an especially favorable setup for Roth conversions and Roth contributions because your current tax rate likely sits lower than it will be in the future. The goal is to deploy inherited taxable funds for living expenses while aggressively filling Roth accounts, creating long-term tax-free growth. With that context established, let's discuss why this approach works so well. This strategy works due to tax arbitrage and compounding. You're using a lower tax rate now to convert or contribute to Roth accounts, creating future tax-free withdrawals that are typically more valuable when your income is higher. Roth contribution room is annual, and use it or lose it, so filling it aggressively is beneficial. Inherited taxable funds offer penalty-free liquidity, allowing you to maintain cash flow while you maximize Roth accounts. Because you have a long investment horizon, broad market exposure allows compounding to work in your favor. Now that you understand the why, let's move into a practical step-by-step plan. Follow this sequence. First, confirm that this is a low-income year. Second, execute strategic Roth conversions from any traditional balances, staying within favorable tax brackets. Third, use inherited taxable funds to pay day-to-day expenses while maximizing Roth, 401k, and Roth IRA contributions. Fourth, avoid leaving large sums idle in cash. Promptly invest taxable funds in a broad market index. Fifth, automate contributions to ensure consistency. Sixth, rebalance annually and keep fees low. Seventh, carefully document all tax-related items, including conversion records and tax forms, and plan for the tax owed on conversions. Finally, repeat this process annually as long as conditions remain favorable. Next, let's visualize the timeline of this approach. This timeline highlights the sequencing. In the initial low-income year, you execute Roth conversions within your targeted tax bracket. Simultaneously, you maximize Roth 401k and Roth IRA contributions each year, supported by inherited taxable funds. You then rebalance and document taxes annually. As your income increases over time, the window for tax arbitrage narrows, but the Roth balances continue compounding tax-free into retirement. Now that the time dimension is clear, let's address the most common liquidity mistake. The biggest mistake is allowing long-term growth capital to sit idle in cash or money market funds. Given your age and long time horizon, the expected return from equities is more suitable for long-term goals than cash equivalents. Money markets are appropriate for short-term needs, but for this strategy's purpose, investors should prioritize prompt, diversified market exposure. Let's compare cash parking to being invested. On the left is cash or money market holdings. These have low expected returns and can lose purchasing power after inflation. They may feel safe, but are not aligned with long-term growth goals and carry a high opportunity cost. On the right is a broad market index. While it carries volatility, the long-run expected return is higher, and diversification helps mitigate risk over time. For long horizons, being invested typically improves outcomes. Now, let's ground this with contribution limits and planning notes. This table summarizes key planning elements. The Roth 401k contribution is shown as $23,500 per the scenario. Always confirm the current IRS limit and employer plan rules. Roth IRA limits change and may have income phase-outs, so verify annually. Roth conversions have no formal cap, but they are taxable, so plan for bracket thresholds and a withholding or estimated payment strategy. Withdrawals from taxable brokerage accounts incur no penalty, but capital gains or losses can be realized, which should be considered. With that context, let's test your understanding with a quick quiz. Quiz time. Which source can you tap for living expenses without incurring early withdrawal penalties in this strategy? Option A, Roth 401k contributions. Option B, Roth IRA earnings. Option C, inherited taxable brokerage funds. Option D, traditional IRA pre-tax funds. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, inherited taxable brokerage funds. Withdrawals from taxable accounts do not carry early withdrawal penalties. In contrast, withdrawing earnings prematurely from Roth accounts or withdrawing pre-tax funds from traditional IRAs can trigger taxes and potential penalties unless specific exceptions apply. Next, let's unpack the tax mechanics with an example. In a low-income year around $55,000, your marginal tax rate may be relatively low. This creates an opportunity to convert pre-tax balances to Roth while staying within favorable brackets. Plan how much to convert to fill lower brackets without pushing yourself into significantly higher rates. Use inherited taxable funds to pay the tax on conversions so that your Roth balances remain fully invested. Track all paperwork, including the 1099-R, Form 8606 for basis and conversions, and your withholding or estimated tax payments. Now let's visualize how cash flows through this strategy. This flow diagram shows the interplay between accounts. Taxable brokerage funds cover living expenses, allowing your paycheck to fully fund Roth 401k and Roth IRA. Taxable funds can also cover the tax bill from Roth conversions. Pre-tax assets are converted into Roth during lower tax brackets. Taxable funds are invested promptly in a broad index to avoid idle cash. All paths ultimately feed long-term, tax-free growth within the Roth accounts. Next, let's look at allocation visuals to guide your equity exposure. This pie chart is a sample allocation for a long horizon. It emphasizes equities through U.S. and international stocks, with a smaller allocation to bonds or cash. It is only an example, not a prescription. Keep costs low by using index funds or ETFs, and rebalance annually. Adjust risk as your circumstances and goals evolve. To reinforce learning, let's do one more quick quiz. The question is, what is the biggest missed opportunity highlighted in this strategy? Option A, not taking on enough debt. Option B, leaving long-term growth funds in cash or money markets. Option C, avoiding Roth contributions to save cash. Option D, only investing in bonds. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Leaving long-term growth capital in cash or money markets risks missing equity returns and compounding. For long horizons, prompt and sustained market exposure is usually more effective. Now, because we discussed financial strategies and taxes, let's include an important disclaimer. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Verify all contribution limits, eligibility rules, and tax brackets with current IRS publications. For decisions tailored to your situation, consult a qualified professional. With that noted, let's summarize the key points. Here are the key points. 1. Use low-income years to complete Roth conversions and contributions. 2. Cover living costs from taxable funds so your paycheck can maximize Roth space. 3. Invest taxable monies promptly and avoid cash drag. 4. Minimize costs, rebalance annually, and document taxes. 5. Allow Roth balances to compound tax-free over decades. Next, we'll provide a concise summary to close out the video. To wrap up, use inherited taxable funds to support aggressive Roth 401k and Roth IRA contributions, using the scenario limit shown for the Roth 401k. Execute strategic Roth conversions in low brackets and pay taxes using taxable funds. Do not leave long horizon capital in cash. Invest early and broadly. Automate contributions, rebalance periodically, and keep careful tax records. Finally, let's end with a creative call to action. Thanks for watching. If you found this useful, please like the video, share it with someone who just received a windfall, and subscribe for more evidence-based strategies. Drop your questions, case studies, and thoughts in the comments. What would you do with an inheritance in a low-income year? See you next time.